We start today's market talk. Markets will continue to swing between fear and FOMO. So, if you have seen, AI frenzy is dividing global market experts. We are witnessing a massive reallocation of global capital into AI infrastructure. When new technology accelerates, capital often gets ahead of underlying potential. Valuations rise simply because everyone else is also buying. So for now, markets will swing between fear and FOMO. But will AI become the engine of the next global growth cycle or set the stage for the next major correction will depend on hard financial maths. So as I have given the heading Bubble Watch, eye of the investors around the globe were focused on the earnings of just one company, that is Nvidia. And Nvidia's earning didn't disappoint. Revenue was up 62% year on year for Q4 it guided to 65 billion in revenue, implying continued acceleration. Market reaction was initially euphoric, but it was down 3% by end of the day. There was no new incremental buy left to push it higher because everyone who wanted to be in Nvidia was already in. This is how an exhausted trend looks like. The accumulation of AI infrastructure is becoming the primary economic imperative. To remain competitive, nations and corporations must accumulate Nvidia chips or make do with less sophisticated ones. For a company and a nation, AI is now an existential necessity. Building and powering these vast AI data centers require immense resources, capital, data, power, and talent. While limited AI exposure positions India as a classic anti AI or reverse AI play, a defensive hedge against AI volatility. Because India is considered as a diversified domestically oriented economy, so it offers kind of stability in this volatile environment. Now, seeing the chart of Nvidia, it had gone up to $210 in last 3 weeks. It has corrected. So it has corrected and come down to its 20 EMA. So either this level will provide support and the bounce from here, or if this breaks, then it will go down further to around 155 odd levels. Now, the other issue which is plaguing the world markets is the rise in the bond yields in Japan. So, the bond yields, which were nearly negative or near zero, have risen to 1.77. And this is what is causing all the worry because of yen carry trade. Now, the yen carry trade is reversing because profits were coming from interest rate differential, while people were borrowing cheap in the Japanese markets and deploying that money for assets all over the world. So when this trade reverses, investors will sell foreign assets, US stocks, Indian bonds, cryptos, and all asset classes. The other issue was the USD INR uh, decline. So if you see here, the rupee declined in big time on Friday in the last hour of the trade. Uh, could be because of rally in dollar, uncertainty on US India trade deal, FI selling, and RBI stepping back because they were protecting the rupee at around 88.80 level. So once 89 was breached, it triggered a wave of automatic stop loss orders, which accelerated the fall to around 89.6 odd levels, and also in addition rising trade deficit. So these are the worries. Now coming to FIDI data, so if you see here, FIs have maintained that 1.7 lakh short positions in index futures. They have reduced their uh, call options, but they have added a put option. So FIs, if you see, they have sold calls and bought puts for index options. So they are net bearish. What have pros done? Pros have, you see, have bought index futures, but sold calls and bought puts and major this thing. So they have bought 2.52 lakh puts for index options on Friday only. So they have turned big time bearish. While clients, they remain bullish, they have bought calls and sold puts. And so their now uh, put positions are at 5.7 lakh. So they have sold 5.7 lakh put positions. So they are net bullish. Now coming to FIDI data. So if you see here, closer to the expiry, the FI short positions reduced. We saw some short covering. And then again, they have added and reached that 1.7 lakh short positions in index futures. This 1.7 lakh, which was there last week also, got reduced this week, where they covered some shorts. But again, once the Nifty crossed 26,000 odd level, but after that, they have added some short positions on Friday. And the day they have been bearish in terms of index futures and index options, the market has generally declined. And the day they have been bullish, the market has really literally gone up. Now coming to US. So if you see here, the US markets posted decline after Nvidia's blowout quarterly results failed to improve the sentiment. US economic data also presented a difficult situation for Federal Reserve. Much delayed September non-farm payroll pointed to a mixed labor market. While the payrolls were higher, unemployment rate ticked up. Remarks by New York Fed President John Williams on further room for cutting rates in the near term helped the sentiment on Friday. So the market posted some gains on Friday. So if you see here, the US bond yields are lower, come down to around 4.067. Expectation is that there would be some Fed rate cuts due to weakness in the US economy and the weakness in the labor markets. While dollar index has strengthened, though this is a divergence because there is a relative risk to other currencies like euro and yen, etc. So the dollar is considered to be the best currency to hold globally. Now coming to gold, gold has actually is consolidating and is at around $4,000 level. It is consolidating at that level. So looking for a clear direction on which to move. Similarly with silver, consolidated around 48, 49 level dollars to an ounce. Now the rate cut direction and the how the geopolitical situation works out will decide the future course of action for gold and silver. Copper is also consolidating, not gone anywhere. Bitcoin declined big time. There's a lot of unwinding of long positions once it crossed the $100,000 mark on the downside. So there is a lot of unwinding. It has come down to around $84,000 level. So it can go up to this 70,000 level from where the rally had started, and then we'll see from there. Brent crude also declined around 2%, 2.28%, because of better geopolitical situation in terms of Ukraine and Russia. S&P 500 declined around 1.95%. Nasdaq declined 3%, basically the sell-off related to AI related names. And Dow Jones also declined 1.9%. It has come taken support at the 20 EMA. Coming to India, the India VIX, because of the lot of short or lot of puts added on um, Friday, has shot up by around 12%. So this should be a sign of worry. It will increase the volatility, but also increase the option premiums. Nifty 50 was up 0.61%, tried to make a fresh all-time high uh, last week, but declined from there on Friday, but still it made a bullish green candle, so there is still momentum. Uh, the only issue is the mid caps and small cap indices are currently in a corrective phase, and their underperformance signals that Nifty's rally lacks broad-based participation that typically defines a strong trend. So coming to the daily chart, it broke out at above 26,100 level, but failed to maintain that. So it closed below that. So this 26,000 should be the first line of support, and then second would be around this 25,800 to 850 level, where the 20 EMA is there. Nifty Next 50, despite the strength in Nifty, has not been showing any strength. Relative strength is declining. Even the RSI is declining. It has come and now coming closer to the 20 EMA. So hopefully this should provide support. Its all-time high was closer to 78,000 level, and now it is nearly 10 to 12% below that level. Nifty Bank, as I had said last week, tried to make it to the first level, that is 59,800, after it had broken out, but got sold off from the top higher level. It made a shooting star on weekly charts, a bearish reversal pattern that usually emerges near the top of the trend. So for this, if you see here on the daily chart, this level of 58,600 to 58,500 zone will provide support. Below that should be 58,300 to 58,000 zone. And breakout above 58,400, 59,400 will restart the upward trajectory. The bigger issue is that the bull run thrives on collective strength, with leaders pulling ahead while rest of the market follows, which is not happening now. So the PSU Bank index, which was breaking out, halted and corrected and made a bearish kind of a pattern. Nifty IT is breaking out. It is poised at a very critical level. So once it breaks out from here, then there would be a clear breakout, at least to 39,000 level. And this is led by Infosys, which above 1565 will become bullish. So it is also facing resistance at that level. Nifty metals, because the strength of the dollar corrected around 3.36%. Now it is below the breakout point. Autos showed some strength based on the strength in iShares and Hero MotoCorp. So it is closer to its all-time high. So let's see if there is a continuation of momentum next week. Defense corrected around 2% because of a decline in HAL, etc., and other defense stocks last on Friday only, basically. Midcaps, it had broken out, Midcap Select had broken out above this 39,500 level, the previous high. But after that, from 14,000 level, it has corrected. So I think this 39,500 odd level should provide some support. Small caps are weak. Now it is below 20 EMA on the weekly chart. So it is now heading lower. The first support should be at 17,600 odd level. After that, it can go down further. It is looking weak, and that is why the portfolios may not be doing well. HDFC Bank, this is a daily chart. So if you see here, it is consolidating around this 980 to 990 level. Tried to break out above 1,000, got sold off. So if this 990 odd level holds, and it can again try to go back to that 1,020 level, where it has where it gets supply 2 3 times now already. Reliance has met its first intermediate target of 15 or 50 odd levels. So it reached there. So if it breaks out from here, it will head to 1600 plus. So that is to be watched. The RSI is strong. Reliance plus Infosys was the one which was keeping the indices afloat on Friday. The rest of the market had declined big time. Hero MotoCorp was one segment or one stock which was in momentum completely last week, went up around 8% after good earnings. So this is one stock which is in strong momentum. The other stocks which are breaking out are Max Healthcare, iShares, Infosys above 1565, Tata Consumer Products, and Federal Bank. Now I'll cover two stocks today. First is Phase Three. It's a home textile industry stock, part of global supply chain, uh, impacted by US tariffs. So, India is a leading supplier of sheets and towels and other products under the cotton home textile segment, given the availability of cotton in India. Home textiles for from man-made fiber, predominantly polyester, are dominated by China. Now, estimated exports are said to be at least 20 times of India. So there is a big opportunity here. Global textile trade is estimated at around 200 billion dollars plus. 50% is owned controlled by China plus Vietnam, and 7% is India in this trade right now. 1% move also implies opportunity of at least $2 billion. That is around 17,000 crore rupees. India can aim for around 15% share by 2030, given the man-made fiber yarn base and know-how. So China plus one is a big opportunity. Presently, there is a headwind because of US tariffs. FTA with UK bring in incremental business movement from Asia to India. Impending FTA with European countries expected on similar lines as UK. Uh, PLI 2 for man-made fiber is the need of the hour to capture the massive opportunity in textiles and China plus one. Land, labor, power, logistics related reforms are imperative. So it is engaged in Phase 3 is engaged in manufacturing of technical and home textile products. Direct exports to the large retailers in USA, UK, and European region are there. Over 90% revenue is export. Share of USA business in the total H1 FY26 income is 62%. It has increased versus 60% in FY25. Company has capability to offer every product other than sheets and towels under home textile segment. Currently, floor covering segment is a dominant product category. Technical and home textile products, floor covering, bath mats, rugs, rubber packed performance and outdoor home textiles made of micro polyester cushions, top of the bed products, blankets, curtain, accessories, etc. are its important products. Handloom home textile product, bath mats, ancient rugs, rugs, throws, cushions, power loom rugs, accessories, etc. are also some of the products. Now, the problem is EBITDA for Q2 FY26, excluding MTM losses impact, is at 10.8. So that has still declined from over 13% in FY25. It remains impacted due to cost incurred on account of imposition of tariffs to accommodate and retain the business momentum. It has invested over 300 crore from internal accruals across units for expansion, new machinery, new location, new technologies, new product lines, and debottlenecking since FY19. PLI scheme of around 10,683 crore for man-made fibers in India is recognition to opportunity, will build optimum supply chain for companies' products. So if you see the business model, direct exposed to customers is around 95% FOB. FOB is free on board. That is, seller is responsible for goods until they are loaded on board the shipping vessel at the named port of export. Uh, they are having good order turnaround, moderate minimum order quantity, flexibility across products and color designs. Markets are basically US and UK and Europe. Uh, 12 customers contribute around 80% of the revenue. Uh, no single customer is greater than 15% of the revenue. Most customers procure multiple products across factories of the company. So basically, the retail chains in US and UK, Europe are their customers. So there is a sizable move for sourcing to India from erstwhile China across companies' products among companies' customers. A lot of demand for these products. It is uniquely placed to have multiple product lines across handloom, technical, and home textile products. Most peers have one or many products. Adequate opportunity and customer appetite for all the existing Indian players in the product categories of the company. Chinese competition, erstwhile headwind, has become a tailwind now because people are diversifying. So there is an opportunity here. Now, these are some of their products. Now, coming to their earnings, the revenues were up 35%. EBITDA after adjusted EBITDA was up 17%, otherwise, was up 17%. Otherwise, it had declined actually uh, because of impacted by the market to market losses due to USD INR forwards for Q2, which ended September 30, 2025 versus gains earlier due to USD INR movement from 85.7 to 88.8 on September 30th. So basically, the depreciation of the rupee affected their position, which they would have taken in terms of their uh, forwards in USD INR. But the key issue is margins have declined on account of adverse impact cost incurred pending resolution of tariffs and trade deal between India and USA. So once the trade deal gets done and this gets stabilized, this should do well. Now coming to their earnings, if you see here, the finance cost, the employee benefit expenses have gone up. The finance cost has also gone up, and other expenses have increased substantially. So there they have said refer note 5. So the positive is 35% revenue growth, capturing market share. 200 crore now is the new baseline for revenue, but the revenue would also have been helped because of better rates they are getting for dollars. For so one has to know how much is the increase in volumes. Though expensive has surged due to higher freight cost, aggressive pricing, discounting, and higher raw material cost. Finance cost seems to be higher due to greater working capital requirement. So one will have to see if the margins can recover. Will they be able to pass the increased input freight cost to buyers in coming quarters? So that one has to watch in this stock. Though to achieve 35% revenue growth, they may be selling at thinner margins, though it is good, but they may be trying to maintain their customers by selling at thinner margins. Logically, foreign exchange gain should boost profit. So this note 5, if you see here, it says other expenses including market to market loss from derivative contract of 16.92 crore and 14.05 crore for quarter and half year ended September 30th, 2025 respectively. So they made losses there. So basically, they would have done a forward contract for their earnings in dollar at around 84 or 85, and then the rupee depreciated more. So they would have made some market to market losses on that. They may have booked that or may not have booked that. That is not yet known. But as per India's sections, uh, that has to be shown in terms of their earnings, and that's why it is reflected in their income statement. Hence, it showed losses, MTM losses this quarter. So that could be one of the reasons. But overall, if you see, the revenue is up around 20% over the last 5 years CAGR, and EPS is up around 11%, and EBITDA is up around 16%. Company estimate FY26 revenue to be at least 20 to 25% despite the challenges of tariffs. Now, so if you analyze this stock, uh, it it was at around 700 plus, then corrected because of this tariff problem, came to around 400 odd level. And then there was a news of increase in the stake in the stock by Ashish Kacholia. So it went up to around 600 level and then has been consolidating post that. Now on the latest news on uh, tariffs, etc., uh, or trade deal related issues, or positive trade deal related issues with the US, the stock has gone up. So, but in my opinion, with the market cap of around 1353 crore and a trailing 12 months profit after tax of 43 crore, this that is adjusted PAT. The stock is at around 30-31p, so it is fully priced. So look for a dip, a good dip to buy this stock. Next stock is Thyrocare. Uh, it's a unique business model built around high volume, low cost, and technology driven centralized testing model, primarily serving the B2B business to business segment. It operates one major central processing labs in Navi Mumbai and a second major lab in Delhi, equipped with highly automated, large scale track systems and advanced equipment. Regional processing labs are strategically located in major cities to reduce turnaround time for certain regional tests. It has a franchise network. The core is the main engine for sample collection, contributing the largest share of pathology revenue. Franchisees, known as authorized service providers or ASPs, are responsible for collecting samples from patients, home collection, walk ins, or referring doctors' labs. The collected samples are transported efficiently from the collection centers to nearest RPLs or CPL via a robust air cargo logistics network, often overnight to ensure fresh samples are processed 24 by 7. Unlike competitors who focus more on direct to consumer model, B2C, its model is heavily reliant on B2B volume, which reduces its marketing and operational overheads per test. By pooling samples from across the country into these few automated hubs, it achieves significant economics of scale. So basically, franchisees, mom and pop collection centers, local labs, nursing homes, and hospitals collect samples. Then they have a partnerships which collects around 32% samples from various platforms, diagnostic aggregators, etc. And some direct to consumer businesses also is there. So this is the basically B2B model. It has got labs all over the country, has around 37 labs all over west, east, north, south, divided into central processing lab, zonal processing lab, regional, satellite, hybrid, and acquired labs. It is diversifying into Tanzania also, that is trying to increase the business in uh, Africa. So basically, within pathology, which is 89% of the total revenue, it has two products, Arogyam, preventive tests, and Janch, lifestyle packages, and general blood test. Then radiology, imaging, advanced diagnostic imaging. So they have these nuclear healthcare focusing on CT scans, MRI, ultrasounds, etc. And then sales of consumers. So this is how they're earning their revenue. Their tests performed have increased by 21%, and revenue per test has gone up by 2%. So straight away they will get a EBITDA growth of 40% plus. Now patients have also increased, active franchisees have increased, so this is their actual moat. Revenue per patient has gone up by 10% and tests per patient have increased by 8%. So it's a good business model for uh, higher prosperity and increase in population in the country. So straight away, if this continues, they will get a EBITDA growth of 40% plus. So if you see here, the revenues have gone up 22% year on year. EBITDA, as I was saying, has gone up 48% and profit after tax have gone up 82% because the EBITDA percentage has gone up. So it has gone up by 6% and that is directly coming into their profit. Now, the growth in pathology in terms of revenue is 24% and radiology is 3%. But EBITDA growth year on year in terms of pathology is lesser, but radiology is more. So radiology is giving more profits as such, EBITDA margins. So now seeing the chart, see here, this stock after results went up, good results went up and then corrected. This is when we had bought this at around 1240, 1250 levels. Uh, and now it has gone up because there is a news on impending uh, bonus, 2 is to 1 bonus this week. So it went up to 1600. Now at 8, it has a 8150 crore market cap. So at around 8,300, 8,400 crore market cap with 127 crore PAT, which is around TTM PAT, trading 12 months PAT. This stock is slightly expensive now, 60 plus times. So the what has to be done is uh, if you have come in for short term, you can book profits because once this bonus is finished, then the stock will come down. I have finished. We will take questions now.